Hi, Assalamualaikum. Today, I would like to present about Module 1, Principle of Islamic Finance. It's up for our project, Sulam project. So, here is about me. My name is Nur Izzatari binti Zamri. Student ID 2021810934. I am at semester 5, Program BBA in Finance, UiTM Puncak Alam. So, what is Islamic finance? Islamic finance operates based on Sharia, Islamic law, which is prohibits practice considered unethical, exploitative, or harmful to society. It emphasizes fairness, transparency, and share risk in financial transactions. In the principle of Islamic finance strictly complies with Sharia law. Contemporary Islamic finance is based on a number of prohibitions that are not always illegal in countries where Islamic financial institutions are operating. So, first one is paying or charging an interest. Islamic consider lending with interest payment as an exploitative practice that favor the lender at the expenses of the borrower. According to Sharia law, interest in usury riba, which is strictly prohibited. Second one is investing in business involved in prohibits activity. Some activities such as producing and selling alcohol or bulk are prohibited in Islam. The activities are considered haram or forbidden. Therefore, investing in such activity is likewise forbidden. Third one is speculation, which is called in Maisir. Sharia strictly prohibits any form of speculation or gambling, which is called Maisir. Thus, Islamic financial institution cannot be involved in contracts where the ownership of goods depends on an uncertain event in the future. Fourth one is uncertainty and risk. Gara. The rules of Islamic finance ban participation in contracts with excessive risk and or uncertainty. The term Gara measure the legitimacy of risk or uncertainty in investment. Gara is observed with derivative contract and short selling, which is provided in Islamic finance. Other crucial principle, material finality of the transaction. Each transaction must be related to real underlying economic transaction. Profit loss sharing. Parties entering into the contracts in Islamic finance share profit and loss and risks associated with the transaction. No one can benefit from the transaction more than the other party. Type of financing agreement. Since Islamic finance adheres to specific restoration and principle absent in conventional banking, unique financing arrangements have been developed with this principle. First one is profit and loss sharing partnership, which is called Mudarabah. Mudarabah is a profit and loss sharing partnership in which one partner, the financer or Rob Bullman, provide capital while the other partners, the manager or Mudarib, manage and invest the capital. Profit are distributed between the two parties on pre-agreed ratio. Second one is profit and loss sharing, joint venture, Musyawarah. Musyawarah is a joint venture where all parties contribute capital and share profit and losses proportionally based on their contribution. The main types of Musyawarah are diminishing partnership, commonly used for property acquisition. In this agreement, the bank and investor jointly purchase a property. Over the time, the bank gradually transfers its share or equity to investor in exchange for scheduled payment. Second one is permanent musyawarah, a joint venture without a fixed end date, continuing as long as all parties agree. This type is typically used to finance long-term projects. Three is leasing, it is called ijarah. In its financing agreement, the lessor who must own the property lease it to lessee in return for predict rental and purchase a payment. At the end of the arrangement, ownership of the property is transferred to the lessee. Investment vehicle. Due to Sharia prohibition, many conventional investment instruments like bonds, options, and derivatives are not allowed in Islamic finance. Instead, the two primary investment vehicles in Islamic finance are: first one is equity. Sharia permits investment in company share, provided the companies do not engage in activity prohibited by Islamic law, such as charging interest, gambling, or producing alcohol or pork. Additionally, Islamic finance support private equity investment. Second one is fixed income instrument. Sharia forbids lending with interest. Conventional bonds are not allowed in Islamic finance. Instead, an equivalent known as a sukuk or Sharia compliant bonds is used. Sukuk represent partial ownership in a tangible asset rather than a debt obligation. So, in conclusion, Islamic finance is a rapidly evolving sector grounded in ethics and values that promote fairness, transparency, and shared responsibility. Unlike conventional financial systems, it prioritizes societal welfare over profit maximization, aligning closely with moral, ethical standards rooted in Islamic principles. So, at the end of our conversation, here is a quiz time to test your knowledge.
Okay.
So, to test your knowledge, what is the primary ethical foundation of Islamic finance?
Maximizing profit, promoting fairness, speculative trading, avoiding the B. B.
Okay. Alright, correct. So, the second one is, which of the following is prohibited in Islamic finance?
Investing in infrastructure project, profit sharing, changing on paying interest, leasing asset. C. C.
Alright, correct. Last one. What is a key future trend in Islamic finance?
Dependence on traditional banking system, decreasing global interest, integration of technology, focus on C.
Alright, the answer is correct. So thank you for hear my presentation. I hope you can understand what I supposedly to explain to you. Thank you.
Right. Later.
Hi everyone and good morning. So today I'm going to present about the module 2, the importance of Islamic finance. So the first one is, this is about me. My name is Nur Afika Meti Azman. My matric number is 2022-806-798. So I'm studying in business administration in finance. So the first one is introductions. Islamic finance has emerged as an effective tool for financing development worldwide, including in non-Muslim countries. Major financial markets are discovering the solid evidence that Islamic finance has already been mainstreamed within the global financial system, and that it has the potential to help address the challenges of ending extreme poverty and boosting share prosperity. The importance of Islamic finance lies in its ability to provide an ethical, stable, and inclusive financial system that aligns with the moral and social values of Islam. It offers a unique approach to economic activity by integrating principles of justice, fairness, and social responsibility into the financial transaction. The next one is the importance of Islamic finance. The first one is ethical framework. Islamic finance operates based on the principles derived from the Sharia law, which emphasize fairness, justice, and transparency. Its practice such as ushur, riba, excessive speculation, gharar, and unethical investment haram, ensuring that financial transactions align with the moral and ethical values. So the second one is the stability in the financial system. By avoiding the speculative investment and excessive leverage, Islamic finance tends to be more stable and resilient to financial crises. It emphasizes on asset-backed financing, means that transactions are more closely tied to the real economic activity, reducing the likelihood of asset bubbles and systematic risks. The third one is risk sharing and partnership. Unlike the conventional finance, which often relies on the debt and interest, Islamic finance promotes risk sharing arrangements. It encourages the partnership where profit and losses are shared between the lender and the borrower. This model can reduce the financial burden on the individuals and businesses while fostering the greater financial stability. The fourth one for the importance of Islamic finance is inclusive financial services. Islamic finance provide financial services that are accessible to a broader segment of society, particularly in a Muslim majority regions. It allows people to engage in financial activities without compromising their religious belief. This inclusivity can promote financial literacy, economic participations, and social mobility. Next, global growth. Islamic finance is growing rapidly and expanding beyond the Muslim majority countries, with institutions in Europe, Asia, and the Americas increasingly offering the Sharia compliance financial product. This growth reflects its increasing appeal as a viable alternative to the conventional financial system, attracting both Muslim and non-Muslim investors interested in the ethical investment. So the last one is encourage sustainable development. Islamic finance principles encourage investment in socially responsible projects that benefit communities and the environment. This aligns with the broader global movement toward the sustainability and responsible investing, focusing on the long-term societal welfare. So next, which is the conclusions of my presentation is, in the conclusion, Islamic finance play a vital role in fostering an ethical, stable, and inclusive financial system by emphasizing principles such as risk sharing, fairness, and the prohibitions of interest. It promotes social justice and financial integrity. Its focus on asset-backed transactions and ethical investment that help mitigate the financial instability and support the sustainable economic growth. Furthermore, as it expands globally, Islamic finance not only serves the needs of Muslim communities, but also provides an attractive and ethical alternative to the conventional finance, contributing to the diversification and resilience of the global financial system. So the last one is we're going to have a quiz time. However, I will leave the link at the chat box so you guys can question the quiz using the link below. Thank you, everyone.
Assalamualaikum and hi. Before we start, let's introduce ourselves. Okay, first of all, my name is Nur Maisara binti Sahaimi, and my matrix numbers is 2022518883, and I am from University Technology Mara. And I am also a student of course FIN546 Islamic Finance, and I am from class NBF 5A. So may I know like you, about you?
Okay, hello. My name is Nurizati Mtiaripin. You can call me Izati. And I'm from Meru. And
Okay, so hi Izati. Okay, today I will do some transferring knowledge for these subjects and my module focusing on comparison between Islamic finance and conventional finance. So I think like before we start, I would like to know if you know anything about Islamic finance and conventional finance.
mm, for me, Islamic finance like avoid interest, and conventional finance likes profit, I think.
Yeah, that's correct. That's great. So I think like you have a basic foundation of this. So well then, let's start our conversations regarding the definitions between the both. Okay, so first of all, as you can see in my slide here, what is Islamic finance? Basically, Islamic finance refer to a system of financial management based on Sharia principles. It emphasizes fairness, ethical practice, and prohibits elements like riba, interest as you said, gharar, uncertainty, and investment in haram such as gambling or alcohol. On the other hand, conventional finance operates under secular law. It focuses on maximizing profits, use interest as its core mechanism, and does not impose ethical restrictions on investments. So now let's take a look on the key difference between these two. As you can see here, I provide a 4 difference, which is interest riba, risk sharing, ethical investment, speculation, gharar. So the first one is interest riba. So basically in Islamic finance, riba or interest is strictly prohibited because it is seen as exploitative. Instead, the system promotes profit sharing agreements like musyarakah, where both parties share risks and rewards. So conventional finance heavily relies on interest. For example, in a conventional loan, the bank charge fixed or variable interest regardless of whether the borrower benefits from the loan or not. I will give you an example. Okay, in Islamic home financing, musyarakah mutanakisah allows the banks and the customer to co-own the house, and the customer gradually buy the bank share. So in contrast, conventional bank charge interest on the full loan house amount. So that's the difference regarding the interest. Okay, and then the second one is risk sharings. So Islamic finance encourage share risk. This is to ensure fairness, since all parties are equally invested in the success of the projects. However, the conventional finance transfer most risk to one party, like the borrower, while the lender enjoy guarantee returns. For examples, in Islamic finance and Islamic business financing agreements like Mudarabah involve profits and loss sharing between the investor and the entrepreneur. In conventional financings, a business loan places all the risk on the borrower. So that's the difference between both. Okay, and then ethical investment. So Islamic finance prohibits investing in unethical industry like alcohol, gambling, or pork related business. But conventional finance has no restrictions, meaning that they can invest in any of sector for profits. They can invest in gambling, they can invest in alcohol, and so on. Okay, for example, Islamic bank won't invest in gambling companies, like I said, but conventional banks maybe they find an industry like casino so that they can get a higher returns. Okay, and then the fourth one is speculations. Speculation is a gharar. So in Islamic finance, it's discourage excessive uncertainty or speculation, such as gambling or high risk derivative tradings. So in contrast of this, conventional finance allow speculative activities, often leading to market instability, as seen in the global financial crisis of 2008. Okay, for example, and Islamic banks avoid speculative investment like betting on currency fluctuations, but in conventional finance, speculative trading in derivative like credit default swaps in commons. So there is like technically the difference between Islamic and conventional finance. So far, do you get what I say?
Yes, so far so good.
Okay, so now let's start with the quiz time. So I have like some quiz. So are you ready? This is a simple quiz.
Right. Okay.
Okay. So the first, my question is, which of the following is prohibited in Islamic finance but allowed in conventional finance? So A is profit sharing agreements. B is risk sharing between parties. C, interest-based transaction. And D is ethical investment.
I think C, interest-based transaction.
Yeah, that's correct. Because interest-based transaction is something related with conventional finance. Okay, the answer is C. Okay, now this one is fill in the blank. Okay, so in Islamic finance, the prohibition of what ensure fairness and avoids exploitative practice.
Riba, I think.
I think that's it. That's also correct. It's riba, interest. Basically, interest is something like Islamic finance won't have. Okay, and then this is the last question, which is Islamic finance allows investment in industry such as gambling and alcohol if they are profitable. Is that true or no?
I think first no.
Yes, it's no, because Islamic finance won't gambling, something related with alcohol and so on, because it is Islamic. Okay, so to summarize it for my conclusions, okay, Islamic finance differ from conventional finance in key area. It's foundation of Sharia principles, the prohibition of riba, emphasis on risk sharing, and focus on ethical investments. So these differences make Islamic finance an ethical and socially responsible alternative to conventional systems. So before we close our sessions, do you have like any question or any thought for you to share to us?
I have a question. How do Islamic banks ensure that their investment are ethical and Sharia compliant?
Okay, so basically an Islamic bank, they are Sharia board to review and approve investment. Meaning like any business that they do, they need to have an approval before they proceed to the investment. So they will ensure that they avoid haram industry like alcohol and gambling. So this is how they avoid and ensure that their banks is Sharia compliance. Okay, and then any other question?
Do you think Islamic finance can be implemented in non-Muslim majority countries?
Okay, so for your information, okay, basically, actually, countries like UK and Japan have implemented Islamic finance service to attract ethical investor, because technically an ethical investor will invest in Islamic finance. So I think yes, it's possible. Uh, do you have any other question? Do you get actually what I try to say?
I think so far, okay, I don't have any question.
All right, that's great. And thank you for your attention, and thank you for hearing my presentation for today and for our transferring knowledge. And I think that's all for me. Thank you. Bye-bye.
Thank you. Bye-bye.
Ya, Bismillahirrahmanirrahim. Today I would like to share to everyone about our Sulam project. The Sulam project that our teammate is mainly on spreading awareness about Islamic finance. So today I will share to all of you about different riba and interest. Before that, let me introduce myself first. My name is Nurul Shafaina Kuzainabudin, and I study in UATM Pucuk Alam in Bachelor of Business and Administration in Finance on Semester 5. Okay, what is riba? In Arabic, it means to increase or to exceed. Concept in Islamic finance that refer to charging interest on loan. Prohibited under Sharia law to ensure equity in commerce. Riba is considered haram or forbidden for both the person who take it and the person who pay it. In Quran, Allah has permitted trade and forbidden riba in Surah Al-Baqarah ayat 275. In Hadith, the Prophet said that Allah cursed the one who consumes riba, the one who gives it, the one who whispers over it, and the one who writes down the transaction. In Ijma, it have explained two types of riba based on general text on the Quran and Hadith, which is first is riba in loan contract, riba al-nasiyah, and second is riba in sale or exchange contract, riba al-fal. The type of riba. First is riba in loan contract, riba al-nasiyah. Riba in loan contract is increased in payment from a borrower to a lender over the original amount charged by the lender due to delay in type of payment. Example of riba in modern financial transaction including interest-based loan, credit card debt, and mortgage. Example riba in the contract. If someone were to borrow $100 and agree to pay back $110 after a year, this will be considered riba al-nasiyah because this lender is receiving and just increase in the amount of money owed. Secondly, type of riba is riba in sale or exchange contract, riba al-fai. It can happen in a sale or exchange transaction of a commodity. This type of riba only apply to commodity, things like date, barley, rice, wheat, oil, sugar, cotton, and etc. If the people exchange the same commodity but in an equal amount, the extra will be riba. Okay, according to hadith, gold for gold, silver for silver, wheat for wheat, barley for barley, debt for debt, sat for sat must be equal on both sides and hand to hand, whoever pay more or demand more on either side. Indulge in riba, Sahih Muslim. There are two main criteria in hadith that qualify a sale has a heavy riba. First is delay in time or deferment of the exchange of commodity. Number two is difference in quality in exchange of similar commodity. Okay, next, interest. English word that come from economic and finance and term used in conventional banking. Commonly specified in advance as percentage of the total loan amount. Interest is prohibited in Islam because it is considered a sin that promotes inequality and economic exploitation. Example type of interest. First is simple interest. Second is compound interest. Third is fixed interest rate. And four is variable interest rate. Simple interest rate is interest calculated on the principal amount of a loan. Secondly, compound interest, the interest payment change each period instead of staying fixed. Number three, fixed interest rate. The interest rate stays the same for the duration of the loan. Variable interest rate is the interest rate can go up and down, often influenced by bank rate change. Common use of interest have 3: credit card. Consumer may make minimum monthly installment payment, and in return, interest expense may accumulate and is earned by the credit card provider. Number 2, mortgage. Mortgage often incur interest over the entirety of their potential 30-year term. The interest may be assessed as a fixed or variable rate. It theoretically reduces over time as the borrower pays down the original loan principal amount. Number 3 is auto loan. Interest is often charged as a fixed rate, and the dealership extending credit may have. Okay, so the difference riba and interest. Riba is a concept in Islamic finance that refers to charging interest on loan. Islamic banking uses a profit sharing system as a workaround to riba, where borrower agree to return a portion of profit as payment for the loan. In interest is a term used in conventional banking. Conventional banking uses interest which is obtained from a direct loan contract. So the conclusion is, in Islamic finance, riba refers to interest charged on loan or deposit, while interest is deemed riba or unjust exploitative gain, and such practice is forbidden under Islamic law. It prohibited in Islam because it considered a sin that promotes inequality and economic exploitation. In Islamic banking, profit is permissible, but interest is prohibited. Islamic bank use sale and purchase contracts such as murabaha, cost plus profit, instead of direct lending. Okay, that's all from me. Thank you. Um, okay, next. Uh,
Review about
I would like you all to review for my presentation. Use the link in chat box. Thank you.
Hi, Assalamualaikum. My name is Nurain binti Muhammad Khalid. So this is my community. Can you explain your name?
Muhammad Zaidi.
Okay. So today I would like to introduce to my community about Islamic banking product. Okay, so first definition of Islamic banking. As we know, it's a banking system based on principle of Sharia. So there is a fundamental principle that is prohibited from the elements is 3, riba, ghara and maisir. Riba is literally mean excess, ghara means uncertainty and deceit. Maisir means gambling. So this is example of Islamic banking product. Okay, we have 10. First, mudarabah, profit sharing. Second, wadiyah, safekeeping. Third, musyarakah, joint venture. Fourth, murabaha, cost plus finance. Fifth, ijrah is leasing. Six is hawala, an international fund transfer system. Seven, takaful, Islamic insurance. Eight, sukuk, Islamic bonds. 9 is Tigna, manufacturing financing, and the last one, 10 is credit cards for Islamic. So this is the examples of Islamic banking in Malaysia. Bank Islam Malaysia Berhad, Alliance Islamic Bank Berhad, Maybank Islamic, CIMB Islamic Bank, RHB Islamic Bank, and Ambank Islamic Berhad. So first, murabaha is a cost plus financing. So this is, we know, financing structure where the bank purchases an asset. Usage is usually in purchasing homes and vehicles. And repayment period is usually installment for a fixed period. Second is mudarabah, profit sharing. So this is one party provides capital or profits are shared according to a pre-agreed ratio, and investment accounts where investors and entrepreneurs share the profit. Okay, musyarakah is a joint venture financing where the partnership agreement will both the banks and customer contribute capital to a venture, and then they will share the profit and losses based on their capital contribution. Usually it's for large scale investment or real estate and business ventures. Okay, ijara is a leasing where it's Islamic lease contract where bank buys an asset and leases it to the customer for a fixed rental fees. Usually it's commonly used in vehicle and property lease. Istinaq is a manufacturing financing where a contract to manufacture or construct goods. So the payment either they made in installment or lump sum upon completion. Commonly used in construction projects such as building homes, factories or infrastructure. And the takaful Islam insurance where we usually know in our daily life also we use it. It's a cooperative insurance scheme where participants contribute to a pool of fund which is used to support other members who suffer from specific risks or losses. Offers such as health takaful insurance, life takaful insurance and general insurance product. Okay, Wadiah is a custody services. It's a deposit or safekeeping arrangement. So like bank holds the customer's money and customer can withdraw deposit anytime. Usually it's like saving accounts and current accounts. And buy a salam is a forward sale, a contract where buyer pays in advance for goods to be delivered in future. So good must clearly defined and agreed upon buyer receive a discount in return for the advance payment. This is different because it's usually used in agricultural financing, such as farmers sell crops to banks before they are harvested. So sukuk is Islamic bonds. Okay, so this is certificates that represent ownership in an asset. So it generates income through a profit sharing, leasing or sales. Usually it's issued by governments, corporation or financial institution to raise capital for large projects such as infrastructure development. And the last one is Islamic credit card. So it operates similarly to conventional credit card but based on Sharia principles. It do not charge interest on outstanding balance, but in Sharia principle may be charged fees for late payments or services. So the repayment method is structured in a way to avoid interest in order for everyday purchases. Okay, so as for conclusion, Islamic banking in Malaysia developed a comprehensive range of products to cater the different financial needs and ensuring compliance with Islamic principles. So it is whether for personal finance, business or investment, Malaysian banks also offer a variety of Sharia compliant alternatives. So this is our last presentation. So I would like to ask some questions for my community. So the first one is how many Islamic banking products in Malaysia, sir?
10 products.
Okay, the second one is what kind of Islamic banking product do you use?
Housing and car loan.
Okay, that's all. Thank you.